What's up, guys? It's me here. So over the last few weeks, I've been working on a brand new series called Credit Cards 101, which aims to educate people on how credit cards work, because it turns out most people do understand what they are getting into when they apply for one. After all, more than 40% of Americans carry a balance from month to month, and 30% of those who have a credit card don't even know the interest rate that they're repaying. That's why this series was created, to go through the ins and outs of credit cards in hopes to help you get a better understanding of how they work, how they make money, and how you can use them to your advantage. Now, while this isn't intended to be financial advice, nor are we licensed professionals, we will be discussing the fundamentals of personal finance so that you could make more educated decisions about your own money, hopefully leading to a better financial future. So we're just kind of starting this off as a community where we can learn together. With that said, before we begin, I need you to smash the like button, subscribe if you haven't done that already, and turn on notifications so you never miss an upload. As a little bit of a thank you for doing that, here's a picture of a goldfish. Alright, now let's begin. So first I wanted to start off by talking about how credit cards work, what they are, what they're used for, and how you can use them correctly so that you don't fall into the trap of debt. See, the way that these things work is pretty simple. You sign up for a credit card, you get issued a specific amount of money that you can borrow against, and then you pay that back over time with interest, unless you pay it off in full. Now, in terms of how much you're able to borrow, also known as your credit limit, that varies depending on your income, your credit score, how long you've had your job, your debt-to-income ratio, how much savings you have in the bank, how many other credit cards you have, and a number of other factors. In this case, the higher your score is, the more likely you are to be approved for a higher limit, since you are perceived as less risky. On top of that, the issuer wants to incentivize you to spend money with that particular card, so they'll often offer a very high credit limit to anyone who signs up, assuming that you'll go out and use it. Now, in terms of how you use a credit card, anytime you buy something, the business gets charged, but the bank does not immediately take the money out of your account. Instead, the bank takes the purchase amount and adds it to your overall balance, which they call your beginning balance. Then, from there, your overall balance increases by any new purchases you make throughout the billing cycle. At the same time, though, you also have the option to make a payment, which reduces your overall balance, leaving you with a final ending balance, which is what they determine your interest rate is based off of. The reason they do this is so that they could earn money off of interchange fees and transaction volume, which is basically another way of saying they make money. Whenever you use your card, whether it's at a restaurant, online, or anywhere else, they charge the merchant a small fee for being able to accept your card. It's typically around 1 to 3% of the total purchase price. For example, if you spent $100 at a restaurant and the business accepted credit cards, the business would only receive $97 to $98.50, while the other $2.50 goes to the credit card company. As you can see, these small fees add up really quickly. And in fact, in 2017 alone, Visa and MasterCard earned a combined $76 billion in revenues, thanks in part to a whopping $2.6 trillion worth of transaction volume. That means every year, Visa and MasterCard collectively make enough money to buy back 25 mid-sized companies. And that's just from interchange fees alone. They also make money from membership fees, late fees, overdraft fees, and interest payments from customers who don't pay off their balances. But in terms of how you, as an individual, could use a credit card properly, that comes down to 3 very important factors that you need to keep in mind. First is that credit cards are essentially a loan. Every dollar that you charge to your credit card is a dollar that you need to pay back. That means you need to view your credit card as money that you don't have yet, and not as a tool to spend more money than you could reasonably afford. Second, I'd recommend only charging what you could afford to pay back within that month. If you know that you're going to have a large expense, like a car repair, a medical bill, a vacation, etc., it's okay to charge it to your credit card to build up points, miles, or cash back, just as long as you have the ability to pay it off in full by the due date. Otherwise, you should just wait until you have enough money saved up in the bank to pay for it outright, because charging something you can't afford to pay back in full is one of the easiest ways to get into credit card debt. Third, you should always pay your bill on time. In fact, 30% of consumers have paid their credit card bills late, resulting in a penalty fee, higher interest, and a lower credit score. That's why I'd strongly recommend setting up autopay so that you never miss a payment. And if you're worried about paying the balance down in full, consider lowering your credit limit so you don't have the temptation to spend more money than you can afford. In terms of how much you're actually going to pay back, the credit card company is going to tack on an interest rate on top of whatever you originally charged. This interest rate is usually between 15 to 25%, and it's going to be applied to the overall balance that you have on your credit card. But that doesn't mean you're automatically going to be charged interest. After all, most credit cards offer a promotional period of 0% interest for a certain amount of time. This could be anywhere from 6 months to a year, and it's a great way to save some extra money if you plan on making a larger purchase like a vacation or a furniture. However, once that introductory period ends, your interest rate is going to go up, and you want to make sure that you have either paid off your entire balance or come up with a repayment plan before the introductory period expires. Otherwise, you're going to be stuck paying 20–25% interest on your outstanding balance, which is something that's going to come back to bite you later. Also, I forgot to mention that not all credit cards have annual fees. Some credit cards have annual fees which range anywhere from $50 to $500 per year, and if the benefits aren't worth it to you, it might be best to avoid them altogether. After all, if the card doesn't make you money or save you money, then there's no point in keeping it. Overall, this stuff should give you a good basic understanding of how credit cards work. And hopefully you have a good idea of whether or not you should be using a credit card at this point. But I think it would be worthwhile to discuss the types of credit cards that exist, because there's a lot more than just debit cards, and I am sure most people don't realize the differences between them. Alright, now let's get back to the video. So in terms of the different types of credit cards that exist, they're generally broken down into 4 categories based on what they offer: rewards, cashback, low interest, or no interest. Starting with rewards cards, these allow you to accumulate points, miles, or other assorted perks that can later be redeemed for cash back, gift cards, or other types of compensation. They are by far the most popular type of credit card, and they tend to be broken down into 3 categories based on how they award their points. The first is travel rewards. These are good for someone who travels frequently and racks up a lot of points or miles. These points and miles can then be redeemed for free flights, hotel rooms, or rental cars. The second is general rewards. These are good for someone who likes to shop at a variety of places and accumulate points that can be redeemed for gift cards or merchandise. The third is flexible rewards. These are good for someone who doesn't want to be locked into one place and instead wants the flexibility to redeem their points for whatever they want. Flexible rewards points typically have less value than the other 2 options, but you're not tied to one place. Cashback cards, on the other hand, give you a percentage of your money back after you spend it in the form of a statement credit. So for example, if you spent $1,000 on a card offering 2% cash back, you'd get a $20 statement credit, which reduces your overall balance by $20. They're pretty simple, easy to understand, and a good way to save some extra money. Low interest cards, on the other hand, are good for someone who plans on carrying a balance month to month, or for someone who needs a little bit more time to pay off a large purchase. As the name implies, these have very low interest rates compared to the national average, saving you money in the long run. Although it is important to mention that you should only carry balance if you can afford to pay it off, and you should always try to pay it off as soon as possible. And then finally, you have no interest cards. These offer the same exact benefits as other cards, except you won't be charged any interest for a certain period of time. This could be anywhere from 6 months to a year, and if you can hold off on any major purchases during that period, you can effectively get something for free. Beyond that though, you also have store credit cards, which are good for someone who shops frequently at a specific retailer and wants to save some extra money on certain items. Secured cards, which are good for someone who doesn't have a credit history and wants to establish one. And then finally, you have gas credit cards, which are good for someone who drives a lot and wants to save some extra money on gas. Of course, with all of that said, you should never apply for a credit card without carefully reading the fine print. Because if you do understand exactly what you're getting yourself into, you could end up paying more money than you ever earned back in the form of rewards. And that's what I've got for you today. I know that was a lot of information, but hopefully you found something valuable and helpful. With that said, you guys, thank you so much for watching. I would love to hear any feedback you have for me. And if you have found something useful or interesting in this video, please hit the like button. If you have found something that you like, share with your friends and family. Feel free to leave a comment below. Let me know what you think. I will reply to your comments. If you have not yet watched the next video, please click on the top right corner of the screen. You will find a lot of exciting information. Thank you so much again for watching, and until next time,